Hello and welcome to this special segment called as MC Pro Select Stock of the Day. I'm your host Nikki Mirchandani, and in this segment, like always, we bring to you fundamentally strong investment stock ideas. Today we're going to be talking about Mahanagar Gas Company, essentially the company which is a city gas distributor company operating in three geographical areas in Maharashtra. The company sells around 3.4 MMSCM of gas daily, nearly two-thirds of which is CNG. It has around 312 CNG stations and has supplied piped natural gas to more than 22 lakh households. Now, let's understand about the recent underperformance which has come through for the company in terms of the stock prices, essentially on correction of fears of international gas price rising again. Three growth factors, actually a couple of them. First one, gas demand ramp up in India, where the push for cleaner energy landscape has prompted the development of a comprehensive gas grid aimed at facilitating a transition from conventional polluting fossil fuels to the more eco-friendly natural gas. A large part of the country still depends upon the alternative fossil fuel to be shifted to gas, which is expected to grow from 6 to 7% to 15 odd percent of the energy mix by 2030. Let's understand this transformation has been buoyed by policy backing, evident through regular auctions of geographic areas which come with exclusive network rights. This approach has attracted numerous players to the sector and has been instrumental in driving the development of gas related infrastructure. Recent changes in gas pricing also has improved the attractiveness of CNG, spurring demand. In terms of other parameters or the factors that we have, a stable gas pricing environment, which seems to be positive for MGL. The current year decrease in spot gas prices has played a pivotal role in enhancing margins across the sector, including MGL. The company has achieved an EBITDA per standard cubic meter SCM of rupees 16.8 in the first quarter of the current financial year, largely attributed to reduced gas expenses. To the counter the deficit in APM, that is the administered price mechanism gas, the industry has effectively bridged the gap through the utilization of HPHT, that is high pressure, high temperature, and spot gas, securing supply at the rate of $12 to $13 per million metric British terminal units, that is MMBTU. Looking ahead, the management envisions an EBITDA per SCM of rupees 10 for the ongoing financial year, indicating a strategic outlook for sustained profitability. Unmatched pricing power is another factor out there where MGN leverages substantial pricing influence primarily due to its strategic presence in the country's financial hub and its surrounding region. Here, gas demand displays lower price sensitivity compared to the rest of the nation. Presently, CNG stands 45 to 50% more affordable than petrol and 16 to 18% cheaper than diesel, leaving a significant gap to the lower prices and improvement of demand. The CNG segment has demonstrated steady growth, achieving a 5% compounded annual growth rate. Let's talk about the Q1 FY24 performance. In the quarter gone by, the company has exhibited strong financial, benefiting from reduced gas costs that led to an improved 85% year-on-year and 31% sequential expansion in per unit EBITDA margins. The quarter witnessed sluggish volume growth due to subdued demand in the industrial and commercial sector put together. Looking ahead, for FY24, the company involves a strategic capital expenditure plan ranging between 600 to 800 crore for enhancing the CNG network and establishing LNG dispensing stations. The quarter also witnessed a rise in private vehicle conversion to CNG, soaring to 14,700 from 13,000 in Q4. The trend is only anticipated to gain further momentum with the recent CNG price reduction. Moreover, addition of 500 to 600 buses by MSRTC is expected to generate around 40,000 kg per day of CNG volume demand this year, contributing to the company's growth trajectory. Let's talk about the valuation. Seem to be reasonable at this point. FY25 PE stands at 11 times. Fear over LNG prices rising further is overstated according to MC Pro. European gas storage is already above 90% levels. We see, or let's just say, MC Pro sees an accumulation opportunity at the current levels. In terms of risks, two factors out there: LNG supply disruption and rise in LNG prices. Apart from that, the rapid transition to EV adds to another layer of risk profile for the company. With this, it's a wrap. Thank you so much for tuning in.